Don't look at my bed. I'm Nest Egg TV. I'm the guy. Face reveal. I'm the guy. Today I'm going to talk to you guys about the stock market and the recent fiasco that's going on with Reddit and Melvin Capital. Because I know a lot of you are like, hell going on? Can I make some money? I'm doing your mom. You know what I mean? Like that kind of stuff. Also, they call me the funny guy. So, give me some funny points. It's how it works. Alright, anyways. The stock market essentially presents the idea that a public business can sell a percentage of ownership to other people. The reason for doing so is that people who invest in a company are providing that business with money, or more sophisticatedly, capital. These slices of ownership are known as shares and can be bought and sold by anybody who can afford them. People make a career simply out of buying and selling these shares, and as a result are referred to as investors. Investing in the stock market is considered a big gambling game, given the fact that business performance is indirectly tied to the value of a share. If a business does poorly or is predicted to do poorly, the share might go down. This would be bad for those who invested right before a dip in value, as they would be losing money. On the flip side, a business which has a stock value increase benefits due to their initial investment being lower than the value of the stock they currently hold. The stock market is made even more complex because people use several different strategies to manipulate the market in their favor. Today, we're specifically going to explore hedge funds, their short-selling strategy, and the stock market fiasco currently taking place. What is a hedge fund? To put it simply, it is, at a basic level, a group of people who trade primarily in liquid. Not like water jugs, like, hey, you want some Mountain Dew? Hey, I got some G Fuel, no way! You know, like that kind of... No, liquid stock means that a stock is easily tradable and can be considered volatile. It's more prone to moving up or down in a shorter time period. As a result of this volatility, and as a further result, high risk, hedge funds can make use of a very lucrative trading strategy known as short selling. Like, they sell short people. It's really funny. It's so funny. But short selling is a strategy where an investor borrows a share, bets on the decline of the stock the share resides in, and then returns the stock, hopefully at a higher price, pocketing the difference. Hedge funds have done this for several decades. It works. But in our specific scenario, which is currently happening in real life, at this very moment, it involves GameStop's public stock, it involves Reddit, and a hedge fund known as Melvin Capital. GameStop is a business that buys and sells used video games at a discount. For context, GameStop usually has a very low stock value. As a business, they're becoming obsolete due to the increasing popularity of digital gaming and poor business decisions such as providing an unfairly low price for games sold to them by customers, and generally having a corporate structure that is disconnected from the stores managed below them. Your typical bureaucratic shtick, the whole like mismanagement quota. As an example, a couple years ago I went to GameStop to sell my PS3 copy of Grand Theft Auto 4. I already had it for Xbox 360, and I didn't want to keep it. It was a brand new copy, it had never been opened, it was still in the plastic and stuff. They offered me $2 for it. So I didn't sell it to them. It was bullshit. Then I looked at their retail price online for a used copy of GTA 4. It was $35. So you can kind of see why GameStop's failing, because they've been having that like mindset for a really long time. And it's not working for them anymore because digital gaming is much more popular. In 2021, you're using Epic Games, Origin, and primarily Steam. A lot of people do. Anyways, Melvin Capital is a hedge fund that made the bet that GameStop's stock price would have gone even lower. And technically it should have, based on the analysis I just gave you. But the Reddit group, or properly called subreddit, known as r/Wall Street Bets, collectively decided to fuck over Melvin Capital, and hedge funds as a whole, by buying GameStop stock en masse, which artificially inflated the stock's value. Melvin Capital began losing money on this because their bet's result ended up being different than they had predicted. And Reddit gained tremendously from this, as they entered mostly around $8 per share, and each share shot up to $300 or $400. I'm talking, this one guy was up $31 million at one point. It was crazy money. And Melvin Capital is down $3 billion. So, you know, Well, the drama comes in when we take a look at what brokerage apps are doing, have been doing. A brokerage app is a middleman that allows you to buy and sell shares for many different companies without having to directly interact with that company. This makes it convenient for your average Joe, like you and me, known as retail investors, to invest in the stock market. By the way, I apologize for the noise in the background. I've got a family that kind of moves around. It's only time of day I can figure out, whatever. Moving on. Brokerage apps like Robinhood have been forced selling shares that people have in GameStop, AMC Theaters, and Nokia. One prediction is that they are doing so as they are on the payrolls of hedge funders like Melvin Capital. And the second prediction, which doesn't falsify or verify the first, is that brokerages were unable to liquidate or pay out shares, so they began to force sell and prevent buying, also known as restricting, because they couldn't pay these shares out. It's huge amount of money that they're unable to liquidate. They're unable to turn that into actual capital that they can give to the people that are pulling out. But in the presence of either of these scenarios, restricting trades like that is illegal, especially because hedge funds like Melvin Capital were still able to short sell while retail investors were left holding the bag. It was market manipulation that unfairly jeopardized the investments of thousands of people, while already wealthy billionaires were able to capitalize. My personal take is that these brokerage apps and hedge funders deserve to be held accountable for what they've done. Straight up. It's illegal, and I think it's fucked. Another fun fact, the economic recession in 2008 was caused by the housing market. Hedge funds like Melvin Capital and Citadel short sold on houses, artificially inflating their prices to personally benefit at the expense of anybody wanting to purchase a house. Banks were willfully complicit in handing out mortgages for these artificially inflated houses, and millions of Americans purchased houses during this time. People who wouldn't even normally be able to purchase houses were approved by banks because hedge funds and banks knew exactly what would shortly happen. When the housing market crashed, the government bailed out the banks, so the banks got saved, and then hedge funds walked away with all the money, while the American public was left holding the bag. A friend of mine actually has parents who purchased a house right before the market crashed back in 2008, and they lost over half the value of their house, and to this day they're still paying the price for that. So it's understandable why people are angry with hedge funds as of now and would want to do something like that on Reddit. And for further context, after the market crash in 2008, hedge funders and other investors on Wall Street they laughed at protesters in the streets and sat up on their balconies drinking champagne and having a good time. So you got kind of an obvious bad guy, good guy situation here. But anyways, that's all for now. If you enjoyed, don't forget to hit the like button and subscribe. This is Nest Egg TV. Peace out.